If you observe carefully the economic history of the last 100 years, you'll discover something disturbing. People who followed the traditional advice of saving money in savings accounts lost more wealth than those who didn't save anything at all. This is not an opinion, it's a mathematical fact. While you watch this video, your savings account is being silently eroded by forces that most people don't fully understand. Inflation, debt cycles, and changes in monetary standards are working against you in ways that few realize until it's too late. During my 50 years observing markets and economics, I've seen patterns repeat constantly. I've seen entire generations of Americans work hard, save diligently, and still discover that their savings couldn't sustain the lifestyle they expected in retirement. The problem isn't that these people did something morally wrong. The problem is that they didn't understand the rules of the game. If you understand the incentives, you understand the behavior, and the incentives of the current financial system are not aligned with the long-term goals of the average saver. Today, we're going to explore why the traditional concept of saving has become obsolete, how economic cycles affect your money in ways you might not realize, and most importantly, what you can do to protect and grow your wealth using time-tested principles. History is an excellent teacher, and it has much to teach us about money, wealth, and financial survival. To understand why saving in the traditional way has become dangerous, we need to go back in time and examine when and why saving worked. Throughout most of human history, storing money was genuinely a smart strategy. Under the gold standard, which lasted for centuries, a gold coin was a gold coin. Its value was determined by the weight of the precious metal it contained, not by trust in a government or central bank. If you saved $100 in gold in 1900 and kept it until 1971, when Nixon ended the gold standard, you would have preserved your purchasing power. In fact, you probably would have gained a little. But observe what happened after 1971. When we removed the gold backing, we created something completely new in human history, a global monetary system based entirely on confidence and governments' ability to manage their debts. This changed everything. Without the discipline imposed by gold, governments could print money in ways that were never before possible. And when you increase the amount of money in circulation faster than you increase the amount of goods and services, you get inflation. Inflation is not a natural phenomenon like a hurricane or earthquake. It's a logical consequence of specific policies. If you create more monetary units, each individual unit is worth less. During the 1,970 seconds, we saw this happen dramatically. Inflation in the United States reached double digits. A person who kept $10,000 in savings in 1970 discovered that this money had the purchasing power of only $3,000 in 1980. They didn't lose their money. They lost their purchasing power. The difference is crucial. Since then, we've had periods of low inflation and periods of high inflation. But the long-term trend has been clear. Money loses value over time when there's no standard that limits its creation. We see this pattern repeat in countries around the world at different times. The Weimar Republic in Germany, Brazil in the 1,980 seconds and 1,990 seconds, Argentina multiple times, Zimbabwe, Venezuela. Each of these cases teaches us the same lesson. When governments have incentives to print money, they do it. And when they do it excessively, money loses value. It's not a prediction. It's a logical consequence. To protect your wealth, you need to understand the fundamental forces that determine money's value over time. There are three central concepts that govern this process. First, monetary illusion. Most people think in nominal terms, not real terms. They see they have $100,000 in their account and feel secure. But $100,000 in 1990 had much more purchasing power than $100,000 today. When you measure your wealth only in monetary units, you're measuring with a ruler that constantly changes size. It's like trying to measure a child's height with a ruler that shrinks a little each year. What matters is not how many dollars you have, but what those dollars can buy. Purchasing power is real wealth. The second concept is the long-term debt cycle. We're currently in a specific phase of a cycle that repeats every 75 to 100 years. It's what I call the long-term debt cycle. During the first half of this cycle, debt grows faster than income. This stimulates economic growth and makes people feel prosperous. During the second half, debt becomes a burden. Interest payments consume a growing portion of income, limiting growth. When we reach the end of the cycle, governments face a difficult choice. Allow a painful deflation, where debts are paid off through bankruptcies and austerity, or inflate the debt away by creating new money to make debts easier to pay. Historically, governments almost always choose the second option. It's politically more acceptable than the first. We're now at a moment where many developed countries have debt levels that were only seen during major wars. The difference is that this time we didn't have a war to justify these levels. The third concept is the hierarchy of assets. Not all assets are affected the same way by economic and monetary cycles. There's a clear hierarchy. At the top are assets that maintain value during crises and periods of monetary instability. Historically, this includes gold, productive land, and businesses that generate real cash flow. In the middle are assets that perform well during periods of stable growth, but that can lose value during crises. This includes stocks of solid companies, well-located real estate, and bonds from stable governments. At the bottom are assets that depend entirely on the stability of the monetary system: cash, savings accounts, and long-term bonds in currencies that can be devalued. The issue isn't to completely avoid assets at the bottom of the pyramid. It's understanding that concentrating all your wealth in them is assuming a risk you might not perceive. If you observe carefully the wealth composition of the most prosperous families throughout history, you'll see a consistent pattern. They maintain diversification that includes assets from all categories, but with a greater concentration in assets at the top of the hierarchy. Let me tell 3 stories that illustrate these principles in action. Imagine an American worker who retired in 1970 with $100,000, a considerable sum at the time. He followed conventional advice and kept this money safe in savings, earning about 5% per year. In nominal terms, his money grew. In 1980, he had approximately $163,000. But what could this money buy? A house that cost $25,000 in 1970 cost $68,000 in 1980. A car that cost $3,500 cost $7,200. Gasoline that cost $0.36 per gallon cost $1.25. His money had grown 63% in nominal terms, but had lost about 30% of its real purchasing power. He did everything right according to conventional advice, but still became poorer. Now consider a similar family that made a different decision. Instead of keeping all the money in savings, they divided their $100,000 like this: $30,000 in savings for emergency liquidity, $40,000 in a house as a real asset, $20,000 in stocks of solid companies, and $10,000 in gold. Throughout the 1,970 seconds, this portfolio performed completely differently. The house appreciated with inflation. Stocks of well-selected companies grew both in value and dividends. Gold multiplied its value several times. Even with only $30,000 in savings losing purchasing power, the family's total wealth not only maintained its real value, but grew significantly. The difference wasn't in luck, it was in understanding the principles. To see these principles on a more dramatic scale, consider a German company in 1920. The owner had 2 options for his accumulated profits: keep them in German marks or invest them in productive assets. Those who kept marks discovered a few years later that entire fortunes had become literally worthless. 1 trillion marks couldn't buy a loaf of bread. But those who had converted their money into factories, land, or even foreign currencies preserved their wealth through the crisis. The lesson isn't that hyperinflation will happen in the United States, although it's a risk that can't be ignored. The lesson is that concentrating all your wealth in a single currency, even the strongest in the world, creates an unnecessary vulnerability. If you understand the incentives You understand the behavior. And current incentives favor policies that tend to reduce the value of currencies over time. Now let's translate these principles to your specific situation. If you're like most Americans between 40 and 80 years old, you probably have most of your wealth in three categories: your house, your retirement account, and your cash savings. Let's analyze each one. Your primary residence is simultaneously an asset and a liability. It's an asset because it tends to maintain value during inflationary periods. It's a liability because it generates ongoing costs and doesn't produce income. The question isn't whether you should or shouldn't have a house. For most people, it makes sense to have one. The question is not treating it as your only real asset. If you observe carefully, you'll see that houses maintain value during inflation primarily because they're real assets, physical things that have utility regardless of the monetary system. But they don't necessarily grow in real value long term beyond inflation. Most American retirement accounts are invested in a mix of domestic stocks and bonds. This is better than keeping everything in cash, but still concentrates your risk in a single country and single currency. Consider the numbers. If you're 55 and plan to retire at 65, your money needs to last at least another 30 years after retirement. This means you're planning for a 40-year period. In 40-year periods, a lot can change. Countries that were dominant can decline. Currencies that seem stable can be devalued. Entire sectors of the economy can be transformed by new technologies. Geographic and asset class diversification isn't just a strategy for normal times. It's insurance against scenarios you hope never happen, but that historically happen more frequently than people expect. Here's where most people make the biggest mistake. They keep years of expenses in accounts that yield less than inflation, thinking they're being conservative. Conservative would be preserving purchasing power. Keeping large amounts in cash for long periods is speculative. You're speculating that inflation will remain low and that there won't be monetary crises. This doesn't mean you shouldn't have cash. You should, but the amount should be calculated based on specific needs: medical emergencies, investment opportunities, unexpected expenses. For most people, 6 to 12 months of expenses in cash is sufficient. Keeping more than that, unless you're planning a specific purchase in the next few years, is transferring wealth to the future in an inefficient way. Let me show you a calculation that most people never make. If you have $500,000 in safe savings, earning 1% per year, and real inflation is 3% per year, you're losing 2% of your purchasing power annually. It might not seem like much, but over 20 years, this means your purchasing power will fall to approximately $330,000 in today's dollars. You didn't lose your money, but you lost a third of your real wealth. If you're planning to live off your investments in retirement, this difference can determine whether you maintain your standard of living or need to reduce it significantly. Now that we understand the problems, let's discuss solutions. The goal isn't to maximize returns, it's to build a portfolio that can survive and thrive in a variety of economic scenarios. Most people think they're diversified because they have stocks from different companies, but if all these companies are in the same country, in the same currency, and are affected by the same macroeconomic factors, you're not really diversified. True diversification means having assets that respond differently to different economic conditions. For periods of economic growth, stocks of productive companies, real estate in growing locations, quality corporate bonds. For periods of inflation, real assets like commodities, real estate, stocks of companies that can pass through cost increases, inflation index bonds. For periods of deflation, long-term government bonds, cash, gold. For periods of instability, gold, currencies from stable countries, assets in politically secure jurisdictions. Based on decades of market observation, I developed an approach I call all-weather, a portfolio capable of working well in any economic weather condition. The central idea is to balance risks, not just allocate capital. A typical allocation might be 30% in geographically diversified stocks, 40% in long-term bonds, a mix of government and corporate, 15% in medium-term bonds, 7.5% in commodities, and 7.5% in alternative assets like gold, REITs, and others. But remember, these percentages are examples, not recipes. What's most important is the principle, balancing exposure to different types of economic risk. You don't need to be a fund manager to apply these principles. Here's a simplified approach. First, maintain appropriate liquidity. 6 to 12 months of expenses in high liquidity accounts. No more unless you have specific plans for that money. Second, build your base of real assets. Your house, if it makes financial sense, perhaps a little real estate exposure through REITs, a small allocation in gold, 5 to 10% of the portfolio. Third, diversify geographically. Not all your wealth should be subject to a single government's decisions. Consider international funds, multinational companies, maybe even a small foreign currency account. Fourth, protect against inflation. Inflation index bonds, stocks of companies with pricing power, commodities through ETFs. Fifth, review and rebalance, not just once a year, but when economic conditions change significantly. Perhaps the most important principle is humility in the face of uncertainty. No one can predict with certainty what will happen with the economy, inflation, or markets. Therefore, the best strategy isn't trying to guess the future. It's building a portfolio that can work well in a variety of possible futures. If you observe carefully how the world's most prosperous families manage their wealth across generations, you'll see they don't bet everything on a single strategy or country. They diversify not just out of greed, but out of prudence. The hardest part of implementing these principles isn't technical, it's psychological. Our minds are programmed to prefer certainty, even when that certainty is illusory. Keeping all money in savings seems safer than having a diversified portfolio, but it only seems that way. In reality, concentrating everything in a single asset class, cash, is one of the riskiest strategies that exist. If you're reluctant to make changes, start small. Move 10% of your portfolio to a more diversified allocation. Observe how it feels. Study the results. Gradually increase as your confidence and understanding grow. The transition doesn't need to be done overnight. In fact, it shouldn't be. Gradual and well thought out changes are almost always superior to drastic and impulsive changes. We've reached the end of our discussion, but we've only reached the beginning of your journey to truly understand how to protect and grow your wealth over time. If there's one lesson I've learned in 5 decades of observing markets, economies, and human behavior, it's this. The fundamental principles of wealth don't change, but their applications must evolve with circumstances. For centuries, saving money was a solid strategy because money was backed by something scarce and valuable. Today, we live in a different world with different rules. Adapting to these new rules isn't optional, it's essential. But adapting doesn't mean abandoning prudence or embracing reckless speculation. It means applying the timeless wisdom of diversification, humility in the face of uncertainty, and preparation for multiple scenarios. History teaches us that there will always be cycles, periods of growth and contraction, moments of inflation and deflation, eras of stability and times of turbulence. What changes is the speed, intensity, and specific causes of these cycles. Those who survive and thrive through different cycles aren't necessarily the smartest or most courageous. They're those who best prepare for uncertainty. In the world of investments and wealth management, this means building portfolios that can function under different conditions. In the personal world, it means developing skills that remain valuable regardless of technological and economic changes. In the world of mindset, it means cultivating patience and discipline to stay the course during periods of volatility. If you understand the incentives, you understand the behavior. And the incentives of today's world favor those who think in systems, who diversify risks, and who prepare for scenarios they hope never to face. Your wealth isn't just a collection of numbers on bank statements. It's your ability to maintain your autonomy, to care for your family, to make choices based on your values instead of your immediate financial needs. Protecting this wealth and making it grow sustainably requires understanding the forces that govern it. It requires accepting that the world has changed and that yesterday's strategies may not be adequate for the future. But it also requires trusting in principles that have worked throughout human history: diversification, humility, preparation, and long-term thinking. It's not a prediction. It's a logical consequence of applying time-tested wisdom to the realities of the modern world. The question isn't whether there will be changes and challenges in the future. The question is whether you'll be prepared for them. As always, the choice is yours.